If you're an American senior, 65, 70, 80, doesn't matter, and you're living on Social Security, a small pension, maybe a little part-time work, I need 2 minutes of your time before you do anything else today. Here's a number I want you to sit with. The IRS says about 1 out of every 5 people who qualify for a certain kind of refund never actually gets it. Not because they did something wrong, not because the government said no, just because the paper that asked for it was never sent in. And this hits older folks harder than almost anyone else, because a lot of seniors stop filing taxes the moment they think they don't owe anything, and that one decision can quietly cost them real money year after year. Now, I'm not going to stand here and tell you the IRS owes every single senior $5,000 because that's just not true, and I won't say it to get you to watch. What I am going to tell you is true, and it still matters a lot because it probably applies to more of you than you think. So let me explain what I mean, because there are really 2 different kinds of people watching this, and both of them are losing out, just for different reasons. The first kind is the senior who files their taxes every single year, sometimes with a paid tax person, sometimes with software like TurboTax. And they figure, well, if there was extra money for me, surely my preparer would have found it. Totally fair thing to assume, but it's often wrong. The people doing your taxes at a busy tax office in February and March are rushing through hundreds of returns. They hit the basics. The specific stuff that applies just to seniors gets skipped a lot more than you'd think. The second kind is the senior who doesn't file taxes at all anymore because their only income is Social Security and they've decided they don't owe the government anything, so why bother with the paperwork? That one assumption right there costs seniors more money than anything else I'm going to talk about today. Here's why both of those groups need to keep listening. There's a kind of tax credit that doesn't care what you owe. If it's worth more than your tax bill, the IRS just sends you the rest in cash. You could owe $0 and still get a check, but only if you actually file and ask for it. No form, no check, nobody calls you, nobody writes you a letter saying, hey, you left money on the table. The system just sits there and waits. So here's what I'm going to walk you through today. 2 specific tax breaks that a lot of seniors miss who actually qualifies for each one. And this is the part I think matters most, how you can go back and check your old tax returns from the last couple of years completely free in case you missed something back then. So here's what I'm going to walk you through today. 2 specific tax breaks that a lot of seniors miss who actually qualifies for each one. And this is the part I think matters most, how you can go back and check your old tax returns from the last couple of years completely free in case you missed something back then. Stay with me through that last part especially, because even if the first 2 don't apply to you right now, there's a real chance one of them applied to you 2 or 3 years ago and nobody ever checked. Let's deal with group 2 first, because this is the one that costs people the most. And it's also the one that's easiest to fix once you understand it. Most credits on your tax return only knock your bill down to 0. They can't push you below that and turn into a check. If you already owe nothing, that kind of credit doesn't help you at all. But there's another kind of credit, a refundable one, that works completely differently. A refundable credit doesn't care what you owe. If the credit's worth more than your tax bill, the IRS sends you the rest in cash. You could owe exactly $0 and still get a check, but only if you file a return and ask for it. If you don't file, there's no check. Nobody reviews your file and decides to send you something out of the kindness of their heart. The money only moves when a form shows up. That part should make you a little annoyed in a good way. The IRS's job is to handle whatever gets claimed. It's not their job to go figure out what you would have gotten if you'd filed. They just sit and wait for the paperwork. So if you're in the I owe nothing, why file camp, that belief is, hand on heart, probably the single most expensive assumption you can make as a senior on a fixed income. Okay, so let's talk about the earned income tax credit, because I think most people, including a lot of seniors, have a mental picture of this credit that's just outdated, and it causes them to skip right past it without checking. When you hear earned income tax credit, you probably picture a working parent with a couple of kids. And for most of this credit's history, that picture's been pretty accurate. There used to be a hard cutoff where if you didn't have a qualifying child, you had to be between 25 and 64 to claim anything at all. Now here's where I have to be precise, because there's a version of this story floating around that gets it wrong, and I don't want to pass that along to you. Back in 2021, during the pandemic relief bill, Congress temporarily removed that upper age limit. So for 1 year, seniors 65 and up without kids in the house could claim it too. A lot of finance content out there talks about that change like it's permanent. It is not. It expired at the end of 2021. For the return you're filing right now, your 2025 return, the rule is back to the old standard. If you have no qualifying child, you need to be at least 25 and under 65 by the end of the year to claim it. So if you're 65 or older with no dependent in the house, the basic version of this credit isn't actually available to you. And I'd rather tell you that straight than dress it up. But, and this is the part worth sitting up for, that age limit disappears entirely if you have a qualifying child. And for a lot of grandparents, that's exactly the situation they're in without realizing the tax code even sees it that way. If you are raising a grandchild, or you're the primary caregiver for an adult child with a disability who meets the dependency tests, age stops mattering completely. You could be 70, you could be 80, and if that dependent qualifies, you can claim the full earned income tax credit on whatever earned income you have. Part-time work, self-employment, gig income, even something like babysitting or selling items online for cash. For the 2025 tax year, with one qualifying child, that credit can run up to $4,328. With two, it's $7,152. With three or more, it tops out at $8,046. That's not pocket change. That's real refundable money, meaning it comes to you even if your tax bill is already at zero. Let me give you a quick example just so this isn't abstract. Say you're 72, you're raising your granddaughter because of a custody situation in the family, and last year you earned about $14,000 doing alterations and tailoring work out of your home. You're also collecting Social Security. On paper, a lot of people in that exact situation assume there's nothing for them. They're retired, they're on a fixed income. Why would the IRS owe them anything? But because that granddaughter is a qualifying child living with you, your age doesn't disqualify you at all, and that $14,000 in earned income could put you right in range for a meaningful credit, possibly in the thousands of dollars, depending on exactly where your income lands. That's the scenario this credit was actually built for, and it's also exactly the kind of situation that gets missed, because nobody thinks to ask a 72-year-old grandmother whether she has a qualifying child. One detail that catches people off guard. Social Security itself doesn't count as earned income for this credit, so Social Security alone won't get you there, but it also doesn't disqualify you. If you're collecting Social Security and you also earned, say, $8,000 or $9,000 doing part-time work last year, that earned portion can still qualify you. There's one more wrinkle, and it's an income ceiling on investment income. For 2025, if your dividends, interest, and capital gains add up to more than $11,950 for the year, you're disqualified from this credit no matter how much earned income you have or how many grandkids are in the house. That's a hard cutoff, not a phase-out, so it's worth knowing where you stand before you assume this applies. Now let's talk about the one that I think is genuinely the most underused form in the entire tax code for people 65 and older, Schedule R, the credit for the elderly or the disabled. This thing has existed since 1976. It was built specifically for seniors and people with disabilities living on fixed incomes. And it might be the least claimed legitimate credit that actually applies to a huge chunk of the population watching this video. Not because people don't qualify, but because most tax software won't even show you the form unless you go looking for it. And most preparers working high-volume tax season jobs are moving through hundreds of returns and applying the standard stuff without digging into Schedule R specifically. Here's how it actually works, and I want to be upfront about something important. This one is not refundable. It can bring your tax bill down to zero, but it can't generate a check beyond that. So if your tax liability is already zero, which is common for a lot of seniors living mostly on Social Security, this credit won't help you because there's nothing left to reduce. But if you do owe some tax, say you've got a pension, some IRA withdrawals, maybe a part-time job, this is genuinely worth checking. You qualify simply by being 65 or older by the end of the tax year, or by being under 65 and permanently and totally disabled with taxable disability income. The credit is calculated off a base amount. $5,000 if you're single, up to $7,500 if you're married and both of you qualify, and then that amount gets reduced based on your non-taxable Social Security and your income above certain thresholds. And those thresholds are tight. For 2025, if you're single, you're phased out entirely once your AGI hits $17,500. Married filing jointly with one spouse qualifying, it's $20,000. Both spouses qualifying, $25,000. For a lot of seniors, once you factor in non-taxable Social Security getting subtracted from the base amount too, the credit calculates down to zero before it even gets a chance to help. So I'm not going to oversell this one. It's a narrow window, but here's exactly who it tends to help. Someone 65 or older with relatively modest income from a small pension or part-time work, who's never had anyone actually run Schedule R against their return. Picture someone who's 68, gets a modest pension on top of Social Security, and maybe earns a little extra doing part-time bookkeeping. Their tax software walks them through the standard deduction, asks about W-2s and 1099s, and spits out a return. And Schedule R never even enters the conversation unless they go digging for it by name. That's not a hypothetical edge case. That's an extremely common profile among retirees, and it's exactly why this form has such a low claim rate relative to how many people would technically qualify. If that's you, or it sounds like someone in your life, it costs nothing to check. And most tax software buries this form unless you specifically search for it by name. Okay. This next part is, I think, the most important piece of the whole video because it applies no matter what happened in the two sections before this. Most people assume that once they've filed a tax return and it's been accepted, that year is closed, done, locked. It is not. The IRS allows you to file an amended return, Form 1040-X, for up to 3 years after the original filing deadline or 2 years after you paid the tax, whichever is later. That amended return can add a credit you missed, fix your filing status, add a deduction, basically correct anything that was wrong or incomplete the first time. The form itself is actually pretty simple. 2 main columns, what you originally reported and what the corrected number should be, plus a column showing the difference, which becomes either a refund coming to you or additional tax you owe. If you're filing on paper, current processing time runs 16 to 20 weeks. If you file it electronically, which has been possible since 2020, it's typically faster, more in the 8 to 12 week range. And you can actually track it. There's a Where's My Amended Return tool right on irs.gov. So here's the actual move. Pull your returns from the last 2 or 3 years. Check whether Schedule E, IC, or Schedule R ever showed up on them. If they didn't, and you think you might have qualified, that's not a dead end. That's an open door for now. The window is 3 years, which sounds generous until you realize most people aren't reviewing old returns looking for missed credits. So the clock runs out quietly and nobody notices until it's gone. I think a lot of people hear amended return or go check old tax filings and immediately assume that means paying a CPA or an enrolled agent. For most seniors watching this, that's just not true. And I want to be specific about why. There are 2 IRS-funded programs built for exactly this. The first is VITA, Volunteer Income Tax Assistance, generally available if your income is around $69,000 or below. The second is TCE, Tax Counseling for the Elderly, built specifically for people 60 and older, with no income ceiling on the base program, and its volunteers are trained specifically on the stuff that trips up retirees: pension income, social security taxation, Schedule R, all of it. The largest operator of TCE sites nationally is AARP Foundation Tax-Aide, and despite the name, you do not need to be an AARP member to use it. Both programs can prepare a 1040-X, an amended return, completely free. Sites are usually set up in libraries, community centers, churches, and they fill up fast, especially close to the filing deadline. So if you're going to use one, the earlier in the season you call, the better. You can find a location through the IRS site locator or by calling AARP at 8882-277-669. You don't need a professional just to find out whether you missed something. The IRS has a free tool called the Interactive Tax Assistant on irs.gov. You pick the credit you want to check. EITC, credit for the elderly, whatever applies. Answer a handful of questions using the numbers from an old return, and it tells you plainly whether you would have qualified and roughly how much. If it's worth more than your tax bill, the IRS sends you the rest in cash. You could owe $0 and still get a check, but only if you actually file and ask for it. No form, no check. Nobody calls you. Nobody writes you a letter saying, hey, you left money on the table. The system just sits there and waits. And if you use a paid preparer and want to know whether they're actually checking this stuff for you, there's one direct question worth asking. Did you run Schedule R for me? And did you check whether I qualify for the Earned Income Tax Credit through a dependent? A preparer who's current on this will answer specifically. If you get a vague answer or they look a little unsure, ask to see the actual worksheet. You're allowed to ask. You're paying for accuracy, not just for a signature. So here's the actual shape of this story, without the hype. The IRS doesn't proactively send you money you didn't claim. It's not going to call you, mail you a note, or recalculate your old returns out of kindness. The system waits for a form, and the form has a shelf life. 3 years, and then that window for that particular year closes for good. Permanently, with no appeal. What changes the outcome isn't having a complicated financial situation. It's knowing 3 specific things: that owing 0 tax doesn't mean there's nothing to file for, that Schedule R exists and is worth checking even though almost no software shows it to you automatically, and that old returns aren't actually closed the way most people assume. If any part of this applies to you, or to your parents, or a neighbor, or someone from church who you know files a loan every year without much help, that's really the only ask here. Go check. It costs a phone call to a free tax site and 20 minutes with a tool that already exists. The window's open right now. It won't be forever.